Looking for a dime. James Locke in the house, gonna help you shine.
Hey everyone, welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. So we have this question from Evan, and he says, how do I know how much life insurance I need, and what do I need to look at? So Evan, you know, the amount of life insurance coverage someone needs can vary quite a bit depending on their specific situation and stage of life. But let me start with when most people first get life insurance. It's usually when they start accumulating debts and financial responsibilities. So you could even be single, but if you have things like a car loan or a mortgage, you may want a small life insurance policy so those debts can be paid off if something happens to you. Now, the loan may be forgiven, all right, but the policy ensures assets like the car can be passed on. However, life insurance really becomes crucial when you get married and start a family, especially if you're one of the primary breadwinners. Now, the main purpose is to ensure your family could maintain their lifestyle if your income was lost. So you have to calculate, after paying off all debts, how much annual income would they need from investments to cover living expenses, children's future costs like education, things like that. You determine that annual income need, then calculate what lump sum that could sustainably generate that income each year from investing in the insurance proceeds. So that lump sum is your recommended coverage amount. Now, life insurance provides that kind of upfront sum, which then gets invested to replace your lost income stream. Now, don't just think about kind of the bare minimum coverage needed. There can be other reasons you may want or benefit from having more life insurance even after your income replacement needs are met. For example, if you have estate planning goals like funding a charitable trust, additional life insurance can provide those funds in a tax-efficient manner. Or if you have a pension income stream, a policy can maximize what your spouse receives from it after you're gone. So, as you're reviewing your life insurance coverage in retirement, look at it from a comprehensive perspective. Yes, you may need less pure income replacement if your costs are lower, but other goals like leaving an inheritance, funding trusts, or maximizing income streams could create a need or make overfunding policies advantageous. An insurance specialist can run all the analysis, your income needs, outstanding debts, projected estate costs, current coverage, pension maximization standards, things like that. They can look at your full picture and make sure you have the right life insurance coverage and projected income stream, whether it's, kind of dialing it down or adding more policies. Don't just let old policies lapse without reviewing. Great question about life insurance there. As always, if you'd like to have your question answered, go ahead and email it in to poollocke@poollocke.com. So we're moving on. Our second question, Ask James question today, is from Allison, still on life insurance. She says, how do I know which types of life insurance policies I should even review, and how will I know what policy is right for me? All right, Allison, it's interesting because, again, this is something that varies a lot based on different people's opinions. And in fact, on one of my recent radio shows I did a few weeks back, we did a show about annuities and talked kind of about the good, the bad, and the ugly, and how people have such divergent views on them. So the same is true with life insurance policy, right? But here's the way I look at it. The truth often lies somewhere in the middle, away from the radical opinions on either side. So it's kind of like if you need housing for just a short period, you'd likely rent rather than buy a home, given the upfront and transaction costs of purchasing. But if you plan to be in an area long term, like raising a family for 20 years, then buying makes more sense from a cost perspective over that stretched timeline. And the same sort of mentality can apply when evaluating life insurance policies. There's two main strategies: term life insurance and permanent or whole life insurance. Now, there are offshoots, but for now, let's focus on term versus whole life. Now, term life is like renting your coverage. You pay annually, the premiums kind of go up over time, and if you stop paying, the coverage expires with no residual value. So if you pass away while it's in force, your beneficiaries get that death benefit payout. But if it lapses, and then your heirs, get nothing back. So term insurance is renting that death benefit year to year as you need it. Now, whole life insurance is more like owning the coverage. You pay a level premium for life. It builds cash value you can access along the way. And eventually, you can be paid up, after enough years where the policy will self-sustain with no more premiums due. It's permanent insurance you own, not rent. So just like the housing analogy, if you just need life insurance to cover a temporary shorter term period, like getting kids through college, then term may be more cost-effective route. You're just renting that coverage for those target years. But if you want permanent lifelong coverage, perhaps to leave an inheritance, then whole life is more optimal since you're paying a level ongoing cost to own that insurance for life. Now, neither policy type is universally good or bad. They're just different tools for different objectives and timelines. An insurance specialist can analyze your specific situation and model out the costs for both term and permanent coverage based on your particular needs and goals. So they'll ensure you're kind of evaluating all the options from a realistic, unbiased perspective. For example, sometimes a combination approach can make sense, using term life for temporary needs like income protection until retirement, while layering on permanent life for things like estate planning and leaving an inheritance. Now, an advisor can run detailed projections so you kind of deploy the right tool for each goal. The key is getting an objective look at the pros and cons of each policy structure, their costs at your age and health level, and how they could help or hinder your overall financial plan. So with that analysis in hand, you can make an informed decision on which type of life insurance is right for you and your circumstances as you transition kind of into retirement. So the policies can be valuable tools when used properly. Two great questions today. Thanks for these great questions. And as always, if you'd like to send in your question, you can do so by emailing them to poolelock@poolelock.com. And hey, if you like what you heard, go ahead, like and subscribe to our channel. I'm James Locke, your retirement income source. See you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.